Disclaimer: this video is for edutainment purposes only, not financial advice. Do your own research and consult a licensed financial advisor before investing. While the retail crowd is chasing overvalued tech giants, a tiny $50 million company is quietly pivoting into a 90% margin cash machine. Today, we're looking at Acorn Energy, ACFN. They just announced a massive partnership. Their EPS grew over 400% in a year, and they have zero long-term debt. Is this the hidden gem of 2026 or a micro-cap trap? Let's dive in. Most people hunting for investments look at the big names: Apple, Tesla, Amazon, and look, there is absolutely nothing wrong with that. Those are huge world-changing companies. But here's the thing, everyone already knows about them. The really explosive growth often happens in corners of the market people ignore. Tiny companies, micro-caps, quietly making massive changes. It's like a small local coffee shop about to sign a deal to be in every Starbucks. One company on my radar, Acorn Energy, ticker ACFN. Right now, as of January 11, 2026, it's a tiny company with a market value of around just $50 million. To put that in perspective, that's not even a rounding error for a company like Apple. But what makes it so interesting isn't its size today. It's the direction it's headed tomorrow. The company just announced a huge partnership, and its earnings per share, or EPS, have shown some absolutely incredible growth recently. So, the big question is this a hidden gem that could deliver incredible returns in 2026? Or is it just another risky microcap that could lose you a lot of money? It's a classic high-risk, high-reward situation. This is not a stock for your retirement fund that you just set and forget. It's a speculative play, for sure, but the details behind its recent moves are compelling enough that they absolutely demand a closer look. We need to break down exactly what this company does. We need to explain what this new deal means, and we need to interpret what the numbers are telling us. In this essay, I'm going to walk you through every single step. Old business, new business, crazy high profit margins, brand new partnership, financial health, risks. So, what does Acorn Energy actually do? If you looked at the company years ago, you would have seen something very different. Historically, Acorn Energy was involved in selling energy infrastructure technology. Think of it as a company that made and sold physical hardware, nuts, bolts, devices that other companies used in their operations. This is a tough business to be in. Selling hardware often means lower profit margins. You have to deal with manufacturing and supply chains, and your sales can be very lumpy and unpredictable from one quarter to the next. But the smart companies adapt, and that is exactly what Acorn Energy has been doing. The company is making a huge pivot away from being just a hardware seller. Visual. A diagram showing a shift from a one-time hardware sale to a recurring monthly subscription service icon. It's moving into the world of the industrial Internet of Things, which people in the industry call IoT. And even more importantly, it's shifting to a software as a service model, or SaaS. This is a massive change. Instead of just selling a device one time, they are now selling a subscription service that brings in steady, predictable money every single month. This is the business model that so many successful tech companies use today. This strategic shift is the core of the entire investment thesis for Acorn Energy. Moving from a one-time sale to a recurring revenue model is like going from being a freelance worker who has to find a new job every month to having a stable, salaried position with a predictable paycheck. For a company, this means better cash flow, more visibility into future earnings, and a business that is much more attractive to investors. The market loves predictable, recurring revenue, and that is the direction Acorn is now aggressively pushing its business toward. The main driver of this new focus is a division within Acorn called OmniMetrix. OmniMetrix is the brand that provides the monitoring services. It's the engine that is generating all of this new, high-margin subscription revenue. Understanding what OmniMetrix does, how it works, and how it makes money is the absolute key to understanding the potential future of Acorn Energy. It's the part of the business that is transforming the company from an old-school industrial supplier into a modern tech services provider. Let's dig into the OmniMetrix service because this is really the heart of the company now. In simple terms, OmniMetrix is a monitoring system. It attaches to critical industrial equipment like backup power generators or natural gas pipelines. Think about a hospital. They have a massive backup generator that absolutely must work if the power goes out. Or think about a utility company that has hundreds of miles of gas pipelines that need to be safe. OmniMetrix installs a small device on that equipment, and that device constantly watches it 24/7. The system gathers data on the health and status of the machine. Is the generator ready to start? Is the fuel level okay? Is there a pressure drop in a pipeline? The OmniMetrix system monitors all of these things and more. If it detects a problem, it immediately sends an alert to the maintenance teams. That lets them fix a small issue before it becomes a massive, expensive, and potentially dangerous failure. It's a proactive system, not a reactive one. It helps companies avoid catastrophic downtime and save a ton of money on emergency repairs. This is where the beautiful SaaS model comes into play. Customers don't just buy the monitoring device one time. They pay a monthly subscription or an annual subscription for the monitoring service. That fee gives them access to the data, the alerts, the online dashboard, and the peace of mind that their critical equipment is being watched around the clock. Now we get to the part that makes any investor's ears perk up. The profit margins. When you look at different businesses, one of the most important things to understand is how much profit they make on each sale. A grocery store might have very low margins, making only a few cents on every dollar of food they sell, but a software company can have incredibly high margins. This is where Acorn Energy starts to look really interesting. The company has stated that its monitoring subscription services, the ones from OmniMetrix, have gross margins that are close to 90%. A 90% gross margin means that for every $100 they bring in from subscription fees, about $90 of that is gross profit. The other $10 is the direct cost of providing that service. After that, the company still has to pay for other things like marketing, sales teams, corporate administration. But having such a high gross margin to start with is a massive advantage. As the company adds more subscribers, profits can grow much faster than costs. This is the power of a scalable software or service business. Once the core platform is built, the cost of adding one more customer is very low. It doesn't require building a whole new factory or hiring a ton of new people. While Acorn still sells some lower margin hardware, the overall blended gross margin for the company was around 78.5% in late 2025. The combination of these high margins with the high 90% plus customer retention rate is a powerful 1-2 punch. High retention means less spend to replace churn, and high margins mean every new customer is extremely profitable. Section 5. The game changer. The new AIO Systems deal. For a small company, one big deal can change everything. In early January of 2026, Acorn Energy announced a deal that could be a complete game changer. The company signed a major 5-year partnership agreement with a company called AIO Systems. AIO Systems is a provider of monitoring solutions, telecommunications, data center industries. Beyond the story and the partnerships, we have to look at the hard numbers to see if the company is financially healthy. Some of the key financial stats for Acorn Energy are actually quite impressive for a company of its size. In one recent year, the company's EPS grew from 0.46 all the way up to 2.66. That is an absolutely massive jump of over 400%. This shows that the company's shift toward higher margin services is already having a big impact on profitability. Another key metric, the company's balance sheet. Acorn Energy reports having zero long-term debt. That means no large interest burden and more financial flexibility to reinvest in growth. Reports show that insiders, meaning management and the board, own about $15 million worth of the stock, real skin in the game. When the people running the company own a large chunk, their interests align with shareholders. Finally, valuation. The stock is trading at a P/E of about 8. For a technology company with high margins and strong growth, that's unusually low. Many similar IoT or SaaS names trade at 30, 40, or higher. A low PE can mean the stock is undervalued, or that the market sees real risks. This is the central puzzle we need to solve. Alright, we've talked about all the good stuff. The high margins, the new partnership, the strong growth. Now, a serious talk about the risks. First, volatility. This is a microcap stock. The stock price can, and will, swing wildly. 10% or even 20% in a single day, sometimes with no apparent reason. If you can't stomach that, this stock is not for you. Second, timing and execution. The bull case depends on the AIO Systems Partnership. Revenue could take longer than expected. Enterprise sales cycles are long. Delays can trigger selling and a price drop. Integration and support must be flawless. Third, liquidity. ACFN doesn't trade many shares. Low volume makes it hard to move size without moving price. Buying a big block can push it up. Selling fast can mean accepting a much lower price. That's why large institutions typically avoid tiny stocks. Finally, concentration. Small companies are less diversified. Lose a big customer, face a superior competitor, or, if the AIO partnership fails, results in the stock could get hit hard. As an investor, you must accept these concentrated risks with microcap investing. So, after looking at the business, the margins, the new deal, the financials, the risks, what is the final verdict on Acorn Energy? The first thing to say is that this stock is absolutely not for everyone. Let me be very clear about that. If you are a conservative investor, if you are saving for a short-term goal, if you get stressed out by volatility, then you should probably stay away. This is a high-risk speculative investment. Be prepared to lose your entire investment. However, for investors with a higher tolerance for risk, ACFN presents a very interesting and compelling story. The strategic shift to a high-margin recurring revenue SaaS model is the right move. The numbers show it's already happening. Strong EPS growth, excellent blended margins. The OmniMetrix service is proven. It works. Very sticky customer base, high retention rates. The balance sheet is clean, zero long-term debt. The AIO Systems Partnership is the real catalyst here. It can supercharge growth by opening telecom and data center markets. With a PE ratio around 8 and a clean balance sheet, it's a rare fundamental play in microcaps. I'm putting this on my high-growth watch list. So, if you find this idea interesting, what should you do next? Do your own research and come to your own conclusions. Don't just buy a stock because you read one essay about it. Here's a simple step-by-step action plan you can follow. Gather more information over the coming months to see if the story plays out. Nothing is guaranteed. Verify the progress. First, read the next quarterly report. Look for official updates on the AIO Systems Partnership, new customer signups, and specific revenue tied to the deal. Listen to the investor call. Hear what management says and what analysts ask. That will give you a real sense of progress. Second, watch key metrics. Total monitoring endpoints, customer ads, retention above 90%, and gross margins. A big drop anywhere is a red flag. Third, if buying, check trading volume and depth. Start very small. Don't bet the farm. Make a speculative position you can afford to lose. Add later if execution continues. Finally, patience is key. The story may take several quarters or a year or two. Small stocks can go sideways before big moves. Put ACFN on a watch list, track from a safe distance, and decide when it's right for you. The potential is there, but with microcaps, execution matters. Watch and verify.